Hello, everybody. Happy Friday to you. Cody Goldsworthy here with Knit CPAs, and we are the CPA firm for real estate professionals because we help our clients save thousands in taxes each year. Today, I want to talk about rental real estate and the role that it plays in your, I guess, somewhat financial picture, but more your tax picture, right? Just finished up two tax returns. One is a pitfall that I found. I see this year over year. I don't know why some CPA practitioners just really don't understand real estate. I'm just going to go over like how it should be reported on your tax return. And then I'm going to dive into, and not really a case study because I'm not going to be talking exact numbers here, but we picked up one of our biggest clients yet this year, late 2024. So we just finished up their 2024 tax return. And compared to what the last guy was doing, we were able to save them about $40,000 in taxes. And a lot of that is through their real estate ownership, their rental real estate. So just wanted to kind of come on here and talk a little bit about the importance of owning real estate as a real estate professional. I could probably do a Facebook Live every week for the next year talking about real estate because I love rental real estate. I own rental real estate myself. I started buying rentals right out of college. It's a great tax shelter. It's a great way to start generating some passive income. And it's also a great tax shelter, which is mainly why I am pushing my real estate professional clients into ownership of rental properties. Um, as a real estate professional, right? So I own rentals. I have losses on my rentals. Most people do, right? Like, even if you run a business that's very asset heavy, like a logging company, maybe a car wash, right? You're owning a lot of capital assets. The amount of depreciation that you generate off of those assets, usually on paper, puts you at a loss, right? So, and one thing too with the Tax Cuts and Jobs Act, and the reintroduction of bonus depreciation, you can generate some substantial losses depending on the asset that you're purchasing. So, rentals. Let's just go for an example that I see quite often. Someone buys a rental property for 150,000. Let's say we determine 50,000 is attributed to the land, so the actual building value is $100,000. I usually see around 25% of that building value is eligible for bonus depreciation. So you bought a house with a mortgage, right? Put, whatever your down payment was, you bought a house. You can take a $25,000 write-off against that house in that first year of ownership. If I do that, that's a suspended loss because it's a passive activity. Rentals are always considered passive unless you can prove that it's more of a business, which we're going to get into here actually in a little bit. But for me, it's not going to offset my income of running a tax and accounting firm. But for you, you can be a broker, you can be an agent. As long as you qualify as a real estate professional, you can make 500,000 in commissions and buy enough rental real estate to completely wipe out all of your income from commissions of selling real estate. It's a pretty extraordinary opportunity for people that are in real estate. Not only that, you're, a broker, an agent, you understand real estate, you're probably getting a great price on it. If you could sell or finance it, I have clients that come $0 out of pocket, purchase a rental, and then take a 50 to $100,000 write-off in that first year of ownership, no cash out of pocket, right? A lot of business owners, they don't get that opportunity. So it's something I'm always pushing my clients that are real estate professionals to start getting into the real estate ownership game because the after-tax return on investment that you have from buying rental properties as a real estate professional is extraordinary. And it's higher than any other, I guess, like client class that I see with our accounting firm. So one of the things I wanted to touch on first is if you already own real estate, right? You're a real estate professional, you own real estate. Make sure that your CPA or whoever your tax professional is, that they're putting it on a Schedule E. I had about eight new clients this year. Um, they had short-term rentals, right? Short-term rentals haven't been out that long, so there's no real strict code on it. You gotta kind of go by the precedents set by the courts on how short-term rentals should be handled on a tax return because they're fairly new, right? So I'm sure the old CPA saw, oh, it's a short-term rental. The average stay is less than 7 days. Let's throw it on a Schedule C. Now that's a pretty easy win for that CPA, right? Because they're going to put it on a Schedule C. It's going to generate 30,000 in losses probably with depreciation. Those losses are directly going to offset your active income. So for me, it would offset my active income because it's a business loss now. A Schedule C is for a business. Schedule E is for rental properties. So a CPA can just throw it on a Schedule C, take a $30,000 haircut on their active income, be like, wow, look at all the money I saved you. But the issue with having a rental on a Schedule C is as soon as you start to turn a profit in that property, you're going to get taxed at the highest rate you ever possibly could. You're a business. You're paying self-employment taxes, all the income taxes, right? Like I mean, as agents, real estate professionals, you guys know how much you get taxed without any tax planning. Like it's substantial, upwards of 50% of your income can be taxed when you're just bringing money into a business like a Schedule C. Whereas a Schedule E, which is considered a passive activity, you get taxed at a more preferential rate, right? There's no self-employment taxes. You're just gonna pay the income tax based on your income tax bracket. So when you turn a profit, a Schedule E is much more beneficial. The real issue I have with rentals on a Schedule C is that once you generate multiple years of losses, you're going to get a letter from the IRS. There's no way around it. You're going to get a letter from the IRS because you're making 300,000 over here as an insurance agent, and then you're taking $50,000 losses and offsetting that W-2 income year after year. You don't think the IRS is going to reach out about that? Of course they're going to, right? You're generating loss year after year after year. They're gonna just say this is a hobby. This isn't a business. What business stays in business generating $50,000 in losses each year? It's just not realistic, right? That's not a business. So that's the big risk for me is that you're gonna start getting scrutinized. You claim losses 3 years in a row, be ready for a letter from the IRS, and now you're fighting to try to prove that your rental property is a business. And by the way, to be a business, you have to provide substantial services and be transient property. Basically, if you rent it out for an average of less than 7 days, you also need to provide substantial services, maybe airport pickups for your tenants, but maybe like a bed and breakfast, cleaning after every night. So if they stay for a week, they're getting a cleaning every morning, right? Like acting more like a hotel, because a hotel is a business, right? That's not rental property. So that's where these short-term rentals kind of get into this murky in-between area. And not only that, but a Schedule E, you can still take these losses generated and offset your active income, even if you're not a real estate professional. Now, there's some rules and requirements that we have. We have to, do a lot of documentation, but you get all the benefits with the Schedule E, and you don't get the downside of all the scrutiny. And then when you actually start making money on the property on paper, you're not going to get raked over the coals with taxes. So if you have rentals, make sure it's on a Schedule E, not a Schedule C. Just go to the page that your rental's on. If you type in the address to upper left, what schedule is it on? If it's Schedule C, I would probably start questioning your tax professional. And then last year, I wanted to talk about this commercial real estate agent that we picked up down in Texas. So he does about 450,000 in 1099 income through his brokerage. So good book of business. He buys 1-2 rental properties a year, just stuff that he comes across that he thinks is a great deal. So he goes ahead and purchases it. He also owns some commercial real estate, and that's actually where his brokerage is. So it's got 18 storefronts. He's one of them for his real estate brokerage. Going through his tax return this first year, there was just so many easy wins on this tax return. And, this guy's in his 50s, so he's starting to slow down a little bit. But, 10 years ago, he was pulling in, $1 million plus, and he was still just paying for this cheap tax professional and these cheap tax services. It's a little bit disheartening. Like there's so much he could have done over the past during his earning years, his 30s and his 40s, if he would have just kind of ponied up and paid someone to do some tax planning for him. But two easy wins I just wanted to talk about here. Maybe they're applicable to you and could help you out. Number one, if you're a real estate professional and you're buying rentals, um, you should be ramping up depreciation to offset your active income. If you go on the Schedule E, look at what your loss is, look what the depreciation is. You want to break your property up into, 5, 15, 27 and a half year properties so that you can identify these items that are eligible for bonus depreciation, and let's write them off in the first year, right? A dollar today is worth more a dollar than a dollar in 5 years. Like, let's get as much money recouped out of the property as we can right now through some tax planning. So we did that for two of his properties, and I told him every time you buy a property, we're going to be bonus depreciating because these are real buy and holds for him. He has no intention on selling. He kind of just wants to use it as a bank, buy it, let it appreciate, cash out, refinance in his retirement years, pull money out tax free out of the rentals. So that's kind of his plan. So, and then when he passes, properties get passed on to his heirs, step up in basis. It's all good stuff. So that's what we're gonna do for him. So that saved, a good chunk in taxes. We saved him 40 grand compared to last year. So so let's say half of that is attributable to ramping up the depreciation on the rental properties. The second thing that we did was, for some reason, his old CPA was not having a self rental. So when you have a piece of property that your business is in, and it doesn't matter the type of business, but let's keep talking real estate professionals because that's what I focus in. His brokerage is in a building. Your brokerage should be paying rent to the landlord, which is you. This is a transfer of income. We're getting it out of the high tax business and we're pushing it into the passive real estate investment, right? I don't know why they weren't doing that. It also just makes sense. Like, you should be paying fair rent for where your brokerage does business. So that's the other thing we did. We determined fair rental rate in 2024, and he's been paying rent to himself basically. You actually want to pay rent, right? Don't just write down that you're paying rent. Like, do things the right way. But now we're getting it out of this high tax business entity. We're pushing it into the rental property, lowering the taxability of it. And not only that, but he's an S corporation. So we took a $40,000 haircut on his profitability in his brokerage. Now we can bring his W-2 earnings down even more, right? Because the earnings are a percentage of your distribution. So saved him like 40 grand in taxes. Super easy wins. He's going to be signing up for our highest package here in 2025. He, came to me, I wouldn't say skeptical, but, he just never really paid for like that proactive service, or really just advisory in general. It was always, here's my money to do my tax return. But actually sitting down, doing advisory through the year, we saved him a good amount of money. He's pretty pumped up about it. We are too. I mean, it's a win-win, right? He paid us good. He's getting a good return on his money. And then hopefully we'll get him on here for a high monthly recurring advisory fee going forward. That's always the goal, right? Like, yes, you might pay a lot for professional services, but as long as you're being returned and rewarded, if not break even, hopefully excess of what you're paying, it's a win-win, right? So that's why I love this business. That's why I love working with real estate professionals. If you need help, be sure to reach out. Happy to talk to you. And yeah, hope you guys all have a great weekend. Bye.